Good morning and welcome to this Wednesday, November 16th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Currently, we've got futures down just a little bit. Dow futures down just a few points. S&P 500 futures down about 4. NASDAQ futures down about 15. Target came out with a pretty rough report. They reported a decline in their profits. They warned of a very soft holiday quarter. And as a result, the stock was getting hit pretty hard. We'll take a look at that chart and all later in the show, but that certainly is not something you want to wake up to. Currently, we've got crude oil futures down about $1, which is about 1.3%. We had finished yesterday up near $87 a barrel. Now we're back down to about 85.75. And the 10-year Treasury yield down 5 basis points, 3.75%. This is the lowest we've seen in a while. It breaks below the recent low. It breaks below the 50-day moving average. It's certainly starting to look like it is trending lower. And that will be good news for the NASDAQ in particular, many of the growth-oriented stocks. We do have Max Payne options expiration this week, so I'm not expecting a whole lot. I mean, the market could take off to the upside, but there is financial incentive, in my opinion, for the market to pause here, maybe even pull back. So I'd be a little careful, but my long-term forecast, which has been bullish, long-term, I've been bullish all year. It was just short-term. I felt like we were set up for a potential cyclical bear market, which we went through. But I think we're done with it. I think the market goes higher. I think rates come down. And the 10-year Treasury yield is going to be one of the biggest clues in exactly what happens with the stock market into the balance of this year and into the beginning of 2023. And currently it is cooperating, coming back down. We know that the Fed in their next meeting is supposed to raise 50 basis points. That's what everyone's expecting at this point after a series of 75 basis point rate hikes. So we're starting to see the slowing there. And of course, we've gotten 2 inflation reports for the month of October. They were just released in November, both showing that inflation is slowing. But it was just October's reports. And the Fed has said they want to see a series of encouraging reports, so that could take us into the beginning of the year. But I think the stock market's already forecasting good things ahead, and I think the bond market's starting to do that as well, which is really encouraging. Anyhow, do want to mention a couple of things over at Earnings Beats before we get into today's action. So for those of you who are new to Earnings Beats, if you go over to our website, earningsbeats.com, we do have a free newsletter. Love to have you subscribe there. 3 times a week, a couple paragraphs and a chart. That's all it is. Name and email address is all you need to give. There's no credit card required. You can unsubscribe at any time. I think you get a lot of great information there. I think there's a lot of value in that newsletter. And we also reach out to anybody who's a subscriber for our free events. We make sure you get room instructions if you'd like to join us. So a number of reasons to join. We'd love to have you. We got certainly a massively growing population on our EB Digest. Second thing I want to mention, we started our fall special on Saturday of this past weekend. It will last for the next couple of weeks, but it's our best deal of the year. The longer you sign up, the more free months and even up to a free year that you can get by subscribing now and extending if you're a current member, or by joining if you're a new member. Best time to try our services right now, because you get a 30-day free trial. And then if you like it, you can always extend using the special that we have for the next couple of weeks, and you will not lose the rest of your 30-day trial. So if you decide in a week that, hey, I want to extend, you just tack it on to the end of your 30-day trial, so you won't lose any time there. One last thing, too. We do have our portfolio draft tomorrow, Thursday. That starts at 5:30 p.m. Eastern. That's when I'll announce the 10 equal weighted stocks that go into each of our 3 portfolios. Having another pretty decent quarter this quarter. Model portfolio looks to outperform for the 10th time in the 16 quarters since we announced it since the inception of the model portfolio. And you might say, well, 10 out of 16, that's just a little bit more than 50-50. When you think about the portfolio managers, who most of which cannot outperform the S&P 500 over a year, I think doing it the majority of quarters is pretty impressive. And we do it based on the themes, what's going on in the market, what we expect to take place in the market. And we're putting together a portfolio not for the next 30 years, but for the next 90 days. So it's a little easier to forecast, companies that are showing relative strength. Wall Street likes them. We should like them. And as a result, I think that's part of the reason for our success. But anyway, that will be on Thursday at 5:30. Members only for that event. So if you'd like to attend and you're not currently a member, try us out. 30-day free trial. I think you'll enjoy the service. And if you don't, no harm. It's pretty much that simple. Anyway, moving on, let's take a look at what happened on Tuesday. We had the Dow Jones Industrial Average up 56 points, S&P up 34, NASDAQ was up 162. Mid caps up 39, small caps up 17. So across the board, we saw strength, most of that strength in the more growth-oriented areas. NASDAQ, mid caps, small caps did better than the S&P and certainly did better than the Dow yesterday. Watching the AD lines to see if we do continue moving up. Do we get the breakout on the AD line? That would confirm it. If we keep going up and the AD line breaks to new lows, that's going to be one signal that will be bearish. And I say one signal because I don't want anyone, finger pointing to just one. There's a lot of different signals that we get. And trust me, some of them are extremely bullish right now. The fact that sentiment is reset is probably the most important one. We're at a point now where the market could take off to the upside based on sentiment at any time. Maybe it has already started with what we've seen here since October. I believe it started. But sentiment was one thing that really bothered me at the beginning of the year, and that issue is 100% resolved. Looking at the sectors, communication services up 1.5%, discretionary 1.4%. Real estate up 1.25%. We saw a nice breakout there on real estate after a pretty rough couple of months. This is a group that certainly seems to be getting its act back together. Technology up 1.2%. Materials was the laggard. Not by much, though, lost 0.15%. And look at materials right up against key resistance. We had just barely cleared the August high, and then we reversed back down. This would be probably a natural time to see a little bit of profit taking in the XLB, perhaps back down to the 20-day moving average. This could be an upsloping neckline. That's what I'm going to believe until I see otherwise. Left shoulder, left side of the neckline, head, right side of the neckline, which is upsloping, which I find to be more bullish than the alternative. And then if we do get this pullback, I'd be looking at that being a right shoulder, maybe back down to the moving averages before a breakout. So overall, I think, technically, most of the areas looking pretty good. Technology, which had lagged for a while, now back up above the 20 and the 50. The 20-day moving average yesterday just crossed back up above the 50. So we're getting a golden cross there. Technology, however, is the one area that's probably the most subject to options expiration this Friday. So if you've been in a lot of these semiconductors, some of these softwares that have made big moves to the upside, I think you've got to be a little careful here. Not to say, I believe they're going higher, but in the very near term with options expiring this Friday, anything goes. A move back down to the 20-day moving average cannot be ruled out. All right, 10-year Treasury yield. First, let's go over some of these economic reports. So we had retail sales out this morning. October retail sales came in. They had increased 1.3%. Expectation was just flat 1%. So they came in better than expected. If we strip out the autos, October retail sales rose 1.3%, which was much better than the 0.5% that was expected. Later this morning, probably in about 5 minutes, we'll be getting the October industrial production. September rose 0.4%. We're expecting October to rise 0.2%. And the October capacity utilization also out here in a few minutes. September was at 80.3%. We're looking for that to just move up slightly to 80.4%. Then later this morning, we get September business inventories. I don't usually look at this, but given what I'm thinking about the Fed and raising rates and potentially slowing the economy, I'm looking for signs of inventory builds. So August, we saw business inventories jump by 0.8%. September, only expecting 0.5%. This is a lagging report. I mean, here we are, middle of November, and we're talking about the September business inventories. So it is a little bit lagging, but still, anything that shows a sign of building inventories, I would be pretty nervous about. Actually, it would probably be a good thing, just because I think it would start to point to why the Fed needs to pump the brakes on those rate hikes. Anyhow, November housing market index also out 10 a.m. this morning. October was 38. We're actually expecting this to drop a little bit to 36. And this does kick off a few housing reports over the balance of the week. Tomorrow, we will get housing starts and building permits. And then on Friday, existing home sales. So we got a lot coming up with housing. And housing's at a key point. I'll show you that chart. I've been talking about that a little bit of late, but we'll look at that chart again as well in just a bit. 10-year Treasury yield. So right now, let's get an update here. Make sure we got the latest. Yeah, we're down 374 now. So we're down 6 basis points. Clearly look like we're trending lower. And that has a major impact potentially with these growth-oriented stocks. And I'll show you that here on this next chart with the S&P 500. So the S&P looks good. We got that gap up. We cleared 3,900. That's kind of been the number. That's kind of been the axis of what we've been going above and below for really the last 6 months since May. We held 3,900 here, bounced, broke down, couldn't clear. Well, we barely cleared 3,900 there, tested it again there, failed. Then we broke out above, went back, tested 3,900. That's when we had our big run up to 4,300. Then when we came back down, where did we go to before we bounced? 3,900. Bounced. Then we lost 3,900, came back up 3 days later, tested 3,900. And then a month later, went back up again to 3,900 before finally breaking out last week. And that was on that positive CPI report. That's where we got the huge gap up and the massive rally on exceptionally high volume. If you weren't in the show the other day when I was talking about that volume, and you look back and say, well, there are several days where you get a lot more. Those were all quad witching days. So when you look, you got March, June, September, and December. Option expiration, those 4 months, that's quad witching. You get a lot of different options, index contracts, futures, all these different things expire simultaneously, and it creates a lot more volume. So if you look back, the third Friday of September is where you see a spike, third Friday of June, third Friday of March, third Friday of December. If you throw those out, the volume that we saw on Thursday of last week was one of the highest of the year. Not only gapping up, but I mean moving straight up all day long and closing on the low. That is a very bullish trend day. And when you throw that in with breaking out above the key 3,900 level, also it was coming off a test of the PPO center line after we had broken out. It also was coming off of this move back down to test both these moving averages. And with that move, we got a golden cross with the 20 back up above the 50. So now we've got price action above the 20, which is above the 50. The PPO is pointing up, showing bullish momentum. All of that is a very, very bullish short-term configuration. And there are going to be many folks that are going to say, well, yeah, but we haven't taken out trend line. We're still in a long-term downtrend. Yes, we are. But we have reset sentiment, which is critical. I mean, that's probably, well, not probably, that was the number one issue I had with the market going into 2022. It wasn't defensive stocks leading. It wasn't the all of the sustainability ratios. They were all important too. They were all part of the puzzle. But the stock market, literally when everyone believes the stock market's going higher and you've put everything you can into the market, there are no more buyers. Sentiment had gone off the charts because of the Wall Street bets, folks. We needed to reset. We needed folks, unfortunately, we needed folks to learn a big lesson. I mean, I've learned it several times over my career, but you get to a point where the market simply can't go much higher And yet everybody believes it can't do anything but go higher. And that's a bad combination. That's what, in my opinion, really started to trigger this selling. And we needed to get a lot of folks bearish, and we're there now. Talk to anybody about the market. Seriously, go out and talk to anybody about the market and what they think's going on with the economy, and just sit back and listen. It's so bearish right now, which is why I think we've bottomed and we're in an uptrend to resume the secular bull market. It also doesn't hurt that we're in this very, very strong historical period that began October 27th and ends January 18th. Been talking about it. We off to a rough start beginning of November, and here we've come right back, setting new highs. This is typical historical action. All right, now, as I pull this chart down, you'll see the 10-year Treasury yield in this panel. And then one of the ratios I like to follow is QQQ versus Spider in this bottom panel. Now, the big problem with this chart down here on the bottom is the fact that interest rates, I mean, this is a mirror image right here. Interest rates going up and the relative performance of the NASDAQ versus the S&P going down. And it makes perfect common sense. The NASDAQ is home to many of the high growth tech names, companies that tend to grow their earnings very fast in a good economy, but also tend to retract those earnings. Those earnings tend to slow in a poorer economy or in a weakening economy. That combination with higher interest rates, if you know anything about valuing companies, I'm a CPA, practiced in public accounting for 20 years. I did valuations. I know this is something very near and dear to my heart. When you get rates moving up that fast and you have to use higher rates to discount future earnings, it completely crushes valuations. Earnings are not as valuable. The future earnings and your future growth is not as valuable in a rising interest rate environment. But if that starts to turn the other way, then we get the flip. And as rates come down, valuations soar. Whether or not earnings are going up or not doesn't matter. Valuations go up just from lower interest rates. So here was the 10-year Treasury yield. I want you to look at every one of these moves. Here was the big move up, beginning of the year. NASDAQ shares, big move down. Had a little bit of a rally, slight rally. Well, I guess we pulled back here, had a little bump. Had a little rally, went back down. Here was a little bit bigger decline in the 10-year Treasury yield. That occurred when we had the strength from mid-June to early August. And then my buddy, Fed Chief Powell, comes out and says, more pain ahead. We're not done. Immediately, everybody sells bonds, rates go up. There goes the QQQ versus the S&P 500. And now we've got the team inflation reports. We see the 10-year Treasury yield. By the way, we've got negative divergences on the 10-year Treasury yield on both the daily and weekly charts. Recently, we had positive divergences on the NASDAQ, well, on major indices, on both the daily and the weekly charts. So what's happening? Yields coming down, stock prices are going up. And with this latest pullback right here to a new recent low on the 10-year Treasury yield, look at the QQQ versus Spider. I think this is just getting started, which is pretty exciting for me, because I think a lot of these growth stocks, which have been beaten up so bad, I said at the beginning of the year, you're going to see an explosion in the fourth quarter. I think we're starting it. Tell you, that last Thursday was certainly an explosion. It's the 14th best day in the history of the NASDAQ. Or maybe it was the S&P. I looked one of them up. Might have been the 14th best day of the S&P. I don't remember which one it was. It was a good day. One of the things I'm going to be looking at as I go into the draft tomorrow night is what's going on with the relative strength of various industry groups. We are seeing some strength now beginning to show up in technology. That was obviously one of the things that we were very concerned with. The turn also came at a pretty important level right here at this relative support area back in May of 2021. Another move down in technology and breakdown below there. The S&P and the NASDAQ are going to only be able to go up so much because technology is the most heavily weighted sector within both indexes. So if you've got this group on a relative basis moving back down and breaking down, and it accounts for the largest part of both of those indexes, how are the indexes going higher? This is obviously a big area that we have to keep watching. And if rates come down, I suspect you're going to see this continue to move up, up, up. Moving on, within technology, I'll just go through the industry groups within technology. Here we have computer services index. It's been, bottomed back in March, made a huge run into June. And then, of course, when the market topped in June, we lost some steam. We're moving back up, and we're almost back to where we were at the June high. So computer services showing some really nice relative strength. And I'll come back to these charts in just a second, but I want to show you one of the charts leading the charge, and that's IBM. IBM, since the October low, which was down around 114, you can see closed at 144. That's $30, or roughly about 26, 27% in a month. 80 line, new high. Look at the relative strength, IBM versus computer services, IBM versus the S&P 500, computer services versus the S&P 500, leading stock in a leading industry group. IBM looks great. And if you want to see something that's really interesting, let's look at the long-term monthly chart on IBM. There was a top at 140. I mean, right now, if we closed out November where we are, it would be an all-time high, finally, on IBM on a monthly basis. We have not had a close over about 140. I think that number right there. This is a key area, and we're about to make, or maybe you could say we're on the verge, or we're in the process of making a big decade-long breakout on IBM. Now, I can't tell you all the stuff that's going on in the company, but I can tell you that Wall Street really wasn't impressed. I mean, think about it. We started our bull market in April of 2013. That's when the S&P broke out above. Let me pull up the S&P. I have to go back a little bit further. Let's go back 30 years. But see the double top here? We didn't really confirm this breakout and this secular bull market until April 2013. That's when we finally cleared that double top. That was the confirmation, April of 2013. And look at what's happened since April 2013. Now, let's go back and look at IBM again. There's 2013. There's April 2013. We're up near 140. We've had this massive run. The S&P 500 is close to triple where it was back then, maybe 2.8 times or whatever, where we were. IBM right now is up maybe $3, $4. But it's just making a breakout. I think IBM is one of the most interesting charts in the market right now. Just because of, I mean, when you have that kind of a sideways rectangular pattern, that's pretty impressive to finally make that breakout. I mean, this was Big Blue. This was the Microsoft and Apple back in the 1980s and into the 90s. I mean, this was, what Apple's done, what Microsoft done, what Tesla. I mean, IBM, if we go in, let me pull up the IBM chart. That's the S&P, but it was actually it was a little bit earlier. Hold on, maybe it was the 70s. Let's go back a little bit further. Yeah, there we go. Well, first it was down here around $6, I guess, something like that, back in 81. And we reached a level of about 25 and 87. That was a 4-bagger there. Then we pulled back, and then look at this run from the 1993 up to 99. We went from probably $4 to $80, 20 times on IBM. And back then we were at $80, and now we're at 140. This is 23 years later. I mean, IBM's been horrible, but after this sideways consolidation period, if we make a breakout, we could see another big surge in IBM. At least I think so. All right, I mentioned earlier the home builders we're going to be coming out with some big reports. I want you to look at this resistance here. I'll annotate it. But right here at 1,300, I mean, you can see here we had this triple, quadruple bottom, and we had a reaction high to 1,300, and then we broke down. And since then, here's a move to about 1,270. Here's 1,250. Here's 1,300, 1,300 cluster up here at around 1,300, and then back down. Last Thursday with that big move up, went right back to 1,300. One thing I find very, very interesting about this chart, though, and this is one of the reasons why I believe rates are coming down. I use intermarket analysis. I don't just look at the news and listen to the Fed and listen to CNBC. I look at what's going on in the market. And when you look at the home builders and you look at what's going on relative to the S&P 500, and we pull this up, look at the relative, look at the bottom in home builders versus the S&P 500. Now, if you've been watching mortgage rates, I mean, I know they came back down late last week, but prior to that, we had mortgage rates that had moved up over 7%. We were down in the twos. Now, we weren't in the twos in April, but we were pretty low back in April. We've had a huge increase in mortgage rates. The market was moving down. Home construction stocks were getting crushed before the latest surge in interest rates. And now, on a relative basis, and even on an absolute basis, we're up near an 8-month high, threatening to break out above 1,300, which would be an 8-month high in a group that is very much subject to interest rates, which have been going straight up. Why, on a relative basis, is Wall Street moving into home construction? Just ask yourself that question. These are the questions you should be asking yourself, not what they're talking about on CNBC. You need to look at intermarket analysis, and just some of it is just such common sense. Home builders are going up. Why are home builders going up? What does the market see that we don't see? It sees lower rates ahead. We're thinking rates are going to go back to double digits. This is the 1970s all over again. Inflation's taking off. I'm seeing signs that are just the opposite. And I'm going to trust these signs because this is where the big Wall Street firms are putting their money. Not what they're talking about on CNBC. This is where their money's going. You get a breakout on 1,300, and there are going to be a lot of folks scratching their heads. I mean, if we get another bad existing home sales report, remember, these reports are in the rearview mirror. Stock market's looking about what's going to happen next quarter and next year. It doesn't care about what happened in September or October. So what confounds many people in the stock market is when you start seeing bad news and then home builders are breaking out to 8-month highs when the industry group looks like the fundamentals are horrible. Again, the market's looking ahead. You've got to look at what's taking place in the charts. All right, earnings this morning. So let's get the latest here on Target. Again, very disappointing forecast more than anything. Now down 29, down to $149. You know, I wrote an article just recently, and it was here, Walmart and Target earnings. Who's winning the retail war? And if you go in and you take a look at that, first of all, I just mentioned that XRT was just breaking above some key relative resistance versus the S&P 500. We'll see whether or not that continues, but mostly we've been just going sideways for the last few months. But I looked specifically at Target versus Walmart, and look at how Target has been performing versus Walmart. I mean, essentially since August, this whole thing's been trending lower. Yes, Target had a couple of days. I even mentioned, okay, we had a couple of days of relative price action, but that does not erase 3 months of downtrend. Wall Street was moving away from Target and toward Walmart. And that's what I said when I wrote this article back on Monday. I said, you can see based on this relative performance that it's tilting in favor of Walmart these last 3 months. So We didn't know the earnings, but we knew Wall Street was favoring Walmart over Target. Now, if I look at the Walmart chart, and we just saw the earnings come out yesterday, we got a gap up and Walmart beat. And then we take a look at Target, which the market just opened. And then we look at Target, look what happened with Target. That's why I say I pay attention to what Wall Street's doing. If Wall Street's doing something, that's what I want to be doing. They've got the money. They've got the MBAs on staff. They know what's going on. Follow the price action. Walmart, shocking. They had good news. Their price is up. Target didn't. And Target is getting absolutely crushed, down 16%. Now, was this a guarantee based on that chart? No. It's a clue. That's all we use technical analysis for. It's not a guarantee. It's a clue. But Target clearly taking it on the chin this morning. Just a couple of other earnings, then we'll wrap up the show as the market just opened. Let's see. Yesterday, Advanced Auto Parts came out, and we'll do these relative charts so we can see what's going on. Target, by the way, just recently had moved up versus the broadline retailers, but it just barely moved up recently, even with that strong couple of days. That was last week. We went from 150 to 170. We had a little bit of a push to the upside, but overall, I think it's pretty clear the group's been going down. And prior to this late October, early November surge, we were down near 52-week lows on Target versus broadline retailers. And that's when basically their quarter ended. So, going into the quarter end, Wall Street goes through a quiet period. They can't talk to companies' executives between the date of earnings and when they release their earnings report. They're not allowed to talk to management. It's a quiet period. That is law. Can't promise you it's always followed, but that is the law. So I like to see what's going on during the quarter when Wall Street can talk. And then sometimes you get these false moves to the upside. Look at this. To me, this was a trap. Moved back up right to resistance right before earnings, and then look what happens. We're all the way back down at the bottom. Anyway, let's look at Advanced Auto Parts. They reported last night after the bell. Look at this move back down. I'll tell you what, they gapped below support in terms of opens and closes. This could fail at some point, and if it does, we could see a big reversal back down to the downside. Now, what the bulls are hoping for is that this is an exhaustive gap. Gap down, final gap, and now we come rallying back. But I tell you, it worries me that it gapped below that prior low. What I would have rather it had done is gap down just above it, trade below it intraday, and then come back. This is suspicious. I'll be interested to see how AAP finishes today. Look at it versus the specialty retailers. I mean, this is a very, very weak stock. If you're buying right now, I'd be careful. Lowe's reported. So we had Home Depot yesterday. Lowe's came out. Looked like Lowe's now trying to make a big breakout. AD line's been coming down, which means what? Means it doesn't usually perform as well in the afternoon as it does in the morning. Therefore, if you get up to this 220 level, that would be the show me level for Lowe's. If we get up there, if I had to take a trade one way or the other, I'd short it. Just because history tells me the AD line's been going down. We're at a major resistance level. I would expect it to reverse off of that back to the downside. And I haven't looked at the earnings report, by the way. I'm just saying that based on what I'm seeing on the chart. And if I did short, and I don't like to short in this market because I do think we're resuming the uptrend. But if I did short, I'd have a very tight stop, much above that 220 level, and I'd be out. TJX. Now, I did expect good things out of TJX. I talked about that in the same article. I said this was the one chart. Look at the relative strength here versus the apparel retailers. Look at the apparel retailers going up. TJX is a leading stock in a leading industry group. When they come out with their earnings, I'm expecting good news. Now, I don't know what they reported, but you can see it was making a big move. It's right up here at key resistance at 76. A breakout over 76 would be very bullish. Or if they beat on top and bottom line and we got to pull back to the 20-day moving average, that's the type of stock I would be all over, personally. We talked about Target. So that's basically it. Let's take a quick look at the market, see what's going on here. Yeah, we got the NASDAQ down 83. Dow's bounced back a little bit here. Let's see what the bond market, what 10-year treasury down 8 basis points right now. I'll tell you, the only reason right now, in my opinion, that the NASDAQ is underperforming is because of options. And maybe a little overbought. We had a big move, but I think it's mostly options. Probably a lot of these semiconductors. Let's look at NVIDIA. NVIDIA was a short candidate, I thought. Yeah, it's down $4 today. It's had a big move up. There's a lot of in-the-money call premium. So as a result, we could see a pullback into options expiration. If some of these big semiconductors go down, the NASDAQ's not going to perform well. And it behooves market makers to bring those prices down right now. I believe this pullback is setting up an excellent buying opportunity on the QQQ. Just my opinion. I mean, my trading, I told members in my trading, I went to cash simply because of Max Payne. I just short term didn't feel great about the market. But as we move lower, I will begin building a position back into the QQQ. Maybe as we get closer to the 20-day, if we get closer to the 20-day on the QQQ, and certainly if we were to get anywhere down near 280, I would be thinking leveraged ETF on the QQQ, which would be the QLD. That's 2 times. I mean, if you're really a risk taker, you go with the TQQQ, which is 3 times the NASDAQ. Just remember they're leveraged ETFs, so you can make a lot of money, but you can also lose a lot of money. You want to be careful, make sure you're very selective with when you get into those, and make sure you keep stops in play. I don't really want to ride a 3 times ETF or a 2 times ETF for very long if it's going against me. Anyway, that's what I see in the market right now. We'll see what happens throughout the rest of the week, but just beware options in the near term. I think that could be a little bit of a factor in holding the market back. But as rates drop, I'm telling you, that's good news. And if we get past options expiration and then rates are still low, I would expect to see another big rally ahead. That's it. Have a great day, everybody. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live episode. Remember, big event tomorrow at 5:30. Going to be putting together our draft, the stocks in each of our 3 portfolios. We've got a great track record versus the S&P 500. And if you want to come to that, all it takes is a 30-day free trial. So go to Earnings Beats and make sure you're set up. Have a great day, everybody. Happy trading.